Okay, we understand mutual funds or pool of investors and all that, and give you some diversification. We talked about actively managed funds where you have a fund manager making decisions on buying and selling. You're basically hiring that fund manager to make decisions. So what are index funds? Where do index funds come? And what is the main advantages and disadvantages of index funds? And really where funds came from was particularly from Bogle, who was a founder of Vanguard. So that's why Vanguard is so well known for index funds. Early start with that, and they do a great job. Is index funds mean you're trying to match the market. You're trying to match that index that's tracking a particular market or subset of a market. You're not trying to beat the market. You're just trying to match the market. You're trying to be average, so to speak. And the advantage of trying to be average is you can have some low costs and things associated with the fund itself that helps you to perform better than actively managed funds. And we'll get into that in the advantages and disadvantages in a second. So an index fund tracks a market, tracks an index. So a famous one I mentioned a couple times before is the S&P 500 fund, Standard & Poor's 500 index fund, the 500 largest United States market cap stocks. So if you want a fund that looks at large U.S. stocks, and it's an index and you want a broad diversification of 500 different stocks, well, maybe the S&P 500 stock fund is for you. By the same token, you could get indexes for different types of things and have funds that track that. Another popular index is the Russell 2000, which is the 2,000 smallest U.S. cap stocks. So if you don't want large cap, you don't want the big stocks, you want the small ones, maybe you're looking for growth and stuff, and you want a broad diversification of 2,000 stocks, well, you can get a Russell 2000 stock index that tracks the Russell 2000, or you can get index things that track a certain sector, like just energy stocks or just healthcare stocks, whatever it might be. You can have indexes that track virtually almost anything. And the idea is that you're trying to match the index. That's the whole key. It's very passive investing where you're not looking to buy and sell stuff. You don't have a fund manager who's actually actively doing that. You just basically have an administrative team that matches up the index, and if things change in the index, one stock leaves the index and a new one comes in, then they might buy and sell at that point to match the index. So their whole goal is to match the index and get better returns by matching the index. And let's take a look at how that works. So if we think about the advantages of index funds and why they're so very popular, is their low cost. When you own a mutual fund, you're incurring costs. You're incurring annual costs. We'll have a whole section on costs and understanding costs in mutual funds. But understand that by holding a mutual fund, you're incurring costs. Versus, let's say, an individual stock where you incur the cost of buying that stock and then selling that stock. Those are transaction costs. Mutual funds hold a bucket of stocks that they're constantly buying and selling within that. Now, an index fund has less of those transactions occurring within the fund. They have some, but they have a lot less. So their costs are lower from a transaction standpoint inside the fund. Also, you're not having to pay a team and some expensive folks to manage the fund, or a team of people to do research and all the stuff that goes into picking stocks at an expert level. You're basically just passively trying to match the index. So another way to reduce cost. And you have the potential within an index to have more diversification in terms of lots of different types of companies, because you can get, the Russell 2000, for example, is 2,000 small cap stocks. The bottom 2,000 of the Russell 3000, which is also U.S., which is all the stocks, or essentially all the stocks. So by getting those Russell 2000, the 2,000 smallest stocks, you don't have to pay somebody to research all those thousands of stocks and pick the best ones for a fund. You just match the index. And so with the low cost, what happens is if you have similar returns, or even if an actively managed fund actually does better than the index, which is rare, but let's say does better than the index, their expenses that are associated with it actually will bring it below the index. Also, they might have more tax implications with those actively managed funds too, thereby also reducing your potential return. So the idea is an index fund doesn't have to do as well to beat an actively managed fund. In fact, there's been all sorts of studies around about index funds, and that they beat like 80% or more of their actively managed peers, and even more so over a longer period of time, because they don't have all that stuff going on. So something to very much look at, particularly if you're looking for a low-cost fund, something very much more safer, let's say, than maybe a very actively managed index fund or actively managed fund. So those are some of the advantages. So what are some disadvantages of an index fund? Because they have disadvantages too. Well, one is you have no fund manager. It's all administratively done. So you don't have a fund manager with a vested interest in it. In an actively managed fund, the fund manager gets paid on how well the fund does. And they get paid big money. These teams get paid big money to do well, to have their fund be the best actively managed fund, or a top 20% actively managed fund. Index, you don't have that vested interest. You're basically trying to match the index. So you might lose out on a really strong fund manager or somebody who could consistently beat the index returns that it's matching up against and be a strong fund manager. It's hard to find them, but they're out there. So understand that you're giving up that as far as the fund manager. Also, if you're buying into an index, you might have a situation where the entire index is down, and so you're going down with that, for example, where a fund manager can actively sell out of something that might be going down and maybe buy something that's undervalued. If you're buying the index, you're fully vested in that index, and if it's going down, you're going down on that ride with it. Same idea as if it's going up, you're going up with it as well. It can be less diversified. Yeah, it can have a lot of holdings like the Russell 2000, of those small cap US stocks, for example. But it can be less diversified and like, I'm just owning that. I don't own any international and I don't own large cap in that index fund. That doesn't mean I can't buy other index funds to give me that. I could buy an S&P 500, or I could buy an index fund for Japan or Europe or whatever. That might also help so you can build your portfolio around it. But each individual index fund itself is just, wouldn't be diversified with that type of thing that might be beyond the scope of that index. So something to be aware of. And they can be one also real tricky little thing to be really aware of, and really looking at the holdings within an index, is it can be heavily weighted in a few positions or a few stocks. For example, the S&P 500 fund, you think, oh, that's 500 stocks, it's 500 equal stocks. It's not. It's a weighted index, which means the bigger of the 500, the top 2, 3, 4, 5, 10, 20, have a much bigger impact than the other, let's say, 480 stocks in there. So things like Google and Apple and Johnson & Johnson and ExxonMobil have a bigger impact on that than maybe the 400th stock in there. And so you're really maybe a little bit more heavy in current times in technology stocks than you might have anticipated, because there's some big technology stocks in the S&P 500. Also, it might be something that's weighted if you have like a sector index fund. I saw a good example of that, like if you look at the energy sector, for example, you could buy an index fund that tracks the energy sector, which sounds great. I get all these different types of energy companies, oil companies, gas companies, pipeline companies, people who build platforms for drilling, anything related to energy. Maybe even alternative energy is in there too, or is in there too, like solar power and wind power, and boy, that's great. I can have all this diversification in energy. Sounds good, but if you look closely at the holdings, there's a big chunk of it. It's like 20-30%. I think it's 20% of the holdings of the energy fund within, let's say, a Vanguard energy fund, or the energy index, not Vanguard, but within the energy index. ExxonMobil dominates it because it's such a big company. That 20% is ExxonMobil. So if you're looking to play more in that alternative energy space, for example, and wind farms and solar energy and all that, really what you're buying when you buy an energy index, you're buying a lot of ExxonMobil, a big oil company. So something to look at when you look at your indexes. So think of the indexes, think about what they're trying to, style-wise, what they're trying to accomplish, but then look at the holdings too to see if that's what you want and what you would like to have within your fund. And also, because they carry lots of different types of stocks in there, there might be some stocks in a large index fund that you might not like. Maybe there's defense contractors in there, or tobacco companies, or alcohol companies. Where if you're buying individual stocks or you're buying individual fund managers, or even actively managed funds that are only buying stocks and things that are not related to what are called sin type things like gambling, defense, tobacco, alcohol, firearms, all that stuff. You can buy actively managed funds like that versus an index fund that's just going to kind of have this broad index. So index funds, some great advantages and very much in vogue versus actively managed funds, which have been struggling. If you look at the overall numbers, index funds historically have been consistently beating actively managed funds, but those few actively managed funds that do well might eke out a little bit better returns, but it's a lot harder to do with all the costs that they have on it. So now there's been a new hybrid that come out, which is ETFs, or exchange traded funds, which are kind of like index funds, but not really. So let's take a look at those.